Insights. We're very fortunate today to have on my far left Jim Gilbert. Jim is now a senior advisor at Welsh, Carson, Anderson, and Stowe. Say that 3 times fast. Before that, he was with Bain and Boston Scientific. Most of you may know from Boston Scientific days. Right between us is Nancy Briefs. Nancy has been involved with so many startups, but you may know her best from Target, Procardia, LMA, and her new one is Infobionics in the fast emerging space of mobile health, given Melena's caution that we not lump everything into health IT, but it's a very interesting thing. So we spent the last 2 hours talking about big ideas and big markets and really a lot about how we're going to finance these things, but nothing ever happens unless we also have a big execution. I think a lot of the stuff we're going to talk about for the next 40 minutes or so are things that we really haven't addressed yet. But I'd like each of you to think about your experiences in the past in helping to bring new technology to market, and think about, from an execution point of view, what were the critical factors? And again, not to frame it in a negative way, but when you think about the things that didn't work and the things that did, what were the differences? What stood out? And Nancy, I'm going to kind of start with you. I mean, you were involved with one tremendous success, Target, and one company that didn't work out, Procardia. What was the difference in your mind between Target and Procardia? And hopefully it won't just be an issue of timing, but tell us a little about Procardia and Target, and what to your mind was the difference between Target's tremendous success and Procardia's not?
Well, it's an interesting question. Both of those companies were big ideas. For those of you that may not recall, I was on the founding team of Target Therapeutics, which was started not initially to do neuroradiology, but to do general radiology and liver embolization. So we took a company literally and turned it on a dime when our early animal work was not working, and we ran into, by accident, a neuroradiologist who told us we could take our catheters to the Circle of Willis. And we were cardiology people. We knew he was neuro, so it had to be above the carotid. But we went and grabbed the tapers and did our homework and came back the next day. And literally the next day, turned the company. There were about, I think at that time, 8 of us, and we decided we would go after the brain. And no one had ever been there, so it was really a big idea. We didn't really know what we didn't know because nobody had taken that approach before. And the technology worked so well that it had a number of starts and stops, but what I can say is that we had a technology that we could prove, we could work with the animals, we had a good animal model, and so it was much more about execution on sales and marketing than it was on R&D. My next big idea, because as my husband says, I was swinging for the fences and I wanted to do it again, was a very novel concept for refractory angina, or patients that had bypass surgery or stents that were occluding. And it was a concept called Procardia, which came out of an incubator in Minneapolis. And the concept was that you would bypass from the left ventricle through the heart muscle, the myocardium, into the coronary sinus. We raised $80 million, 300 plus animals. It looked like the technology would work. We figured out first how to do it surgically, then how to do it with a catheter. If you can imagine getting up with a catheter, the coronary veins, making a puncture, dropping in a covered stent, and getting out in one procedure under 2 hours. I mean, it was a real engineering feat, unlike the earlier catheters. Unfortunately, the technology didn't work in humans, because the animal models where we had tried to create a damaged myocardium did not reflect what had happened in humans who had, 20, 30 years of refractory angina. And all the stents started closing, so we didn't know how to get around the physiology. We didn't know if it was a drug that needed to go on. We had heparin coating on the stent, but we also thought that it may be related to changes in pressure and flow into the coronary sinus that was creating an intimal hyperplasia. So the difference between the two was that one, from a catheter point of view, was much easier at Target, even though it was a bigger marketing challenge. And at Procardia, it was a tougher technology challenge but the physiology got the best of us. And so I think that was the difference. Team-wise, I think they were, I'm kind of biased. I think they were both A-plus teams, very dedicated and very passionate. So
I want to come back to that in a little bit, because I think there's a further question that we'll ask. But Jim, let me turn it back to you. And I'm thinking now, well, I mean, from your perspective either at Welsh Carson but I'm thinking mostly from your perspective at Boston Scientific. Obviously, to some degree, a successful exit is in its own right a measure of success for companies. But I know that as we were having a conversation, and we were talking about success as Boston Scientific perceived it, and particularly both as you viewed it from what the companies had accomplished up until the point of the acquisition, and even what happened after the acquisition by Boston Scientific. You raised a lot of interesting questions about, raised a lot of interesting issues about what was there and what wasn't there in terms of what would have made for a more successful company. Talk about some of the things that you saw at Boston Scientific that made you think to yourself, if only that company had planned differently, proceeded differently, done some different things, would have made the difference between maybe not so much a successful exit or not, but between a successful commercialization or bringing that technology to the patient as opposed to one that simply didn't get there.
A lot of good discussion points today. One area that hasn't been talked about is the moving execution hurdle that has happened in MedTech over time. If you think about the description of what a company needed to be 10, 15, 20 years ago for a successful exit versus the requirements today, at least the perception I have, the standard has moved up dramatically. And at Boston Scientific, we ourselves were forced to put that in practice. As we think about the diligence, if you think about the ultimate endpoint is a successful exit, we've talked about that IPO is rarely a window open for successful exit. So the exit is going to become from someone coming in, making a decision that there is a company there to invest in. If you look at the set of diligence frameworks that people are using today, they're very different than what folks were using before. At Boston Scientific, we organized our diligence framework around 4 key questions. We've heard various forms of questions today, but I think these 4 resonate with a number of things people have said. Is question number 1, does the product work? Secondly, can you prove it? Third, will you get paid for it? And fourth, can you scale and make money selling it? Those were the 4 fundamental questions. We had a series of diligence questions underneath of those. And if you think about the life cycle of executing, building a company, they tend to focus successfully in succession going after those 4 questions. But ultimately, as an investor at Boston Scientific or an investor at Welsh Carson, where we'll come in as a growth capital or classic private equity type role, we focus on those 4 questions, sub-questions under each of those. And later, if David wants, I can spend time talking about example situations that as much as you'd find the company scored well on a number of dimensions, especially the fundamental dimension that the technology was a big idea with fundamental potential, you'd find one of those areas where you'd find a fundamental issue. And because of that fundamental issue and the implications from a do-over time, investment, and ultimate success versus competitors in it, we would make a decision to back off the investment. But I can talk through it.
But I would like you to pursue some examples and do so right now. But let me tee up the examples you're about to give us by asking you whether during your time at Boston Scientific, which is what, 2003 to
2004 to 10,
or today in your role at Welsh Carson, when you saw a company that came to you with a not particularly well thought out reimbursement plan, maybe not having done the proper clinical studies or needing more clinical studies, did you see that as an opportunity, i.e. we at Welsh or Welsh Carson or we at Boston Scientific can plug in those gaps and we can put a lower valuation on the company, or was it a negative? I mean, did you look at that at Boston Scientific and say, "Oh my gosh, we're buying a headache here because we can put the money down, but once we bring it in house, we've got a lot more work to do here"? give us some examples of the kinds of things that were negatives as far as you perceived them when you were at BSC. And also, what was your view about it when you saw a company that came in that clearly had failed to execute on some of those critical points?
Yeah, excellent question. And the short answer is it all depends, and it depended on exactly the factors you'd imagine, which is how fixable is the point with our complementary strengths, in what period of time, at what expense, and did it have some fundamental impact on the investment thesis? And so when the answer was absolutely yes, you really had to walk away. When the answer was no, it's something you could add value to it, you would negotiate it as part of the price you would pay. So
did people understand that you were putting a lower valuation because they simply had not done enough of their own legwork or homework?
Well, ultimately, as you'd expect, a negotiation is just that, a negotiation, and it all depends what other exit options they had, and you'd basically, be negotiating about the market price rather than the discount you're placing on them because of the quality of their clinical work. You would make those observations, but ultimately it's like any negotiation. It's a relative power struggle at the end of the day of what is going to be paid, and absolutely from either a Welsh Carson perspective or Boston Scientific perspective, you'd have your set of disciplines you'd be applying around ultimate valuation and believing that the risk-adjusted return potential was there. So ultimately, you'd have a walk-away discipline if you couldn't get the negotiation done.
So give us some examples. And I'm struck particularly by one you said, which is, does the technology work? I'm thinking about Precardia, where the animal studies, the human studies proved or suggested that the technology really does not work. But I'm a small company. I've come to Boston Scientific. I'm sitting across the way from Jim Gilbert, and I say, of course the technology works. Well, are you kidding me? I absolutely know it works. That's why we're having this conversation. And you say, no, from Boston's perspective, here's what you haven't proven. What was that gap?
So let me just sort of walk through the 4 questions and examples here, because there's a whole bunch of companies you really wouldn't bother to spend a lot of time from, because they just, per the discussions we've had earlier, you don't fundamentally believe in the technology and its potential, and you screen through 10 to 20 venture-backed companies to find one company you're going to spend time actually having real discussions with, and it's probably a 10 to 20 to 1 ratio. And sort of the sidebar comment I would have is, one of the watch-outs that we're all alluding to that's changing the world is big corporations. The reason we do business development is because, per Art's point, we know we're not very good at it. But the other reason we do it is we know that the way the venture world works, it funds a lot of ideas on a risk-adjusted set of economics, which are much better than the economics that we would ever fund on. So we've almost counted on a world of funding existed to get these companies started, so we can look at 10 or 20 companies that have been funded and decide which ones might be worthwhile for our shareholders in the case of Boston Scientific, or our limiteds in the case of Welsh Carson should invest into it. But once they pass that hurdle, let me just walk through some examples. So you have the classic IP set of issues, and that's pretty well a black and white set of issues. You get your lawyers, outside patent folks involved. They make their set of judgments as whether there's a real issue or not. I remember multiple times I would have just a passionate disagreement with them, but I can't think of any time over my career that it didn't turn out to be good warnings out there. There are a couple of example companies that Boston Scientific passed on for IP reasons, which other companies bought, which for multiple years it looked like the other companies that our lawyers had just been wrong, which recently over the last couple of years have, caused technologies to be knocked off the market. I can think of, the Conceptus versus Ardiana is a recent example. We like that technology. We wanted to invest in that company. We correctly decided not to. Obviously, per the comment Bob made earlier, BSC in total in the stent market made a decision that we could, or at least a judgment that we could outrun the issues there. But it's, J&J has come back pretty well and is clearly making more money off of its IP agreements with Boston Scientific than Cordis is selling stents these days. So IP tends to be black and white. Clinical studies, back to your question, is the people say this works. Engineering-wise, I can show on the benchtop this works. Judgment around the clinical study and the ultimate legs of those clinical studies matters a lot. A lot of people do the clinical studies just to get through the regulatory path. From our perspective, it was both a test for regulatory path, but also a test of will it engage the market and give you the power of the indication you want. A example where we got caught up on this, less because it was the quality of the clinical study, but the underlying reality behind it, was an investment we made, and Art can probably know better than I, the fourth or fifth investment Boston Scientific made in the AAA space. We really liked Trivascular. We had invested in them. We had spent multiple years working with them. At some point, we thought we really needed to invest to build out the company more fully than a venture-backed company. We bought them in. We put significant investment behind it. It turned out in a clinical study, as we looked at the pictures more carefully, we discovered there was a broken stent, and there was some fundamental redesign work that was needed that just would, from an economics of BSC at that point, not be a set of economics we could support. And so,
well, had Trivascular just not done enough clinical studies, or did they just have one bad?
Well, it was not the clinical study that turned out to be the problem. It was a group of very smart, capable engineers who had thought they had created every possible bench test to flex a stent to know that this stent would last and work in human beings. And as you know, that the bench tests are only as good as what they choose to test. In a dynamic engineering world, a single mode test rarely captures all the motions of a human body, and they had missed some fundamental insights of what actually happens when you put a AAA stent in a human being. The thing fractured. It needed to be redesigned. There needed to be different testing to get it done. And so we shut the program down. Luckily, the original venture team came back and wanted to buy it out. And so Trivascular has been refunded and going, but at a do-over set of investments that BSC just wasn't willing to fund at that point in time. So those are just some examples early on of stuff that can be 0-1, and if we had discovered that earlier, we would not have gone forward.
Hey, let me stop you there, because you all have some other examples. Let me turn to Nancy. So you've heard two things that Jim has said. Speaking of a big company perspective, you worked with a lot of small companies in a variety of different areas. Are you hearing big company overkill? These guys just want surety where surety can't exist. They want guarantees where guarantees can't exist. They want IP protection which is over the top. Or do you take his point that as you think about what you've had to do as a small company started with limited resources and trying to spend some very expensive money, do you say, yeah, there are times when we've had to go ahead when we haven't done fully everything? I'm just interested in the small company reaction to what he said, because it's easy for Boston Scientific with its tremendous resources to say you haven't tested enough or you haven't done enough of the IP search. Do you agree that that's a problem small companies face, or do you say at some point, I could be doing IP searches for 40 years and still figuring it out?
So again, I don't think it's a black and white answer. Before I answer that, I do want to say that when I was at Procardia, I had a terrific experience at Boston. Paul LaViolette, and I think you were in the room, Jim, brought in about 12 people when we had finished our animal studies and let us present to them. And they gave us incredible feedback about what we should do in humans, how long we should look at the stents, and I was, to this day, forever grateful. So from the CEO's seat...
What did you hear in that session that you didn't know? By that time, you were a pretty seasoned executive.
Right.
Medtronic gave you the opportunity because they thought you really knew what you were doing. How is it that Paul LaViolette saw stuff that you didn't see, or his dozen people?
Well, I think I don't know if we didn't see it, but it was clear because Medtronic was a strategic investor and on the board that what they wanted to see in clinical trials was a little bit different than what Boston wanted to see. And so what was helpful for us is it was the first time we had gone outside of kind of our comfort zone and asked someone else, what do you want to see in the follow-up? So I think the only way you can get that information is to talk to the companies, right? And I was impressed that they were so collaborative and so helpful for us at that time. So I just want to say that. I know that companies often I'm on my 6th company, so having sold companies to Abbott and Medtronic can tell you that everybody wants something different. But what I've learned, to answer your other question, which we've been doing at this new company, InfoBionic, very carefully, is we have taken all of those experiences to heart, and in light of how hard it is to get funding, we have set out from the very beginning to make sure that things, even including reimbursement, are part of our strategy. So in our case, if you try to look us up, we're Stealth. We've been in existence about 15 months, but there's not much on the internet. We're basically a mobile health company. There are 4 founders. 2 of our founders talk about disparate. One comes from EMC Cloud Storage. One is a professor of cardiology at Mass General, myself, and then another engineer. And we're trying to disrupt the market for arrhythmia monitoring with a single device running in the cloud, faster, cheaper, and better results. And we did that in 1 year, completely self-funded, Stealth. But what we did that year, which we wouldn't have had to do 5 years ago because we could have gotten VC money easily, is we self-funded it. We hired a reimbursement consultant. We looked at 32 different CPT codes to make sure we could get paid. We hired the best lawyers we could find. To your question on patents, we've looked at 350 software patents because our IP is all around software and delivering it as a SaaS model, software as service. We also did primary market research and went out and talked to cardiologists and electrophysiologists, both in the U.S. and in Europe, and said, this is a $3 billion market. What is it you don't have that you want? And they told us, which was amazing to me because it was easy to get the guys in Boston to tell us, but these were people that didn't know us. And we did all of that and put together a partnership on manufacturing before we ever went out this year to raise money. And 5 years ago, I would have done none of that. I would have filed a provisional patent. I would have found a couple of doctors and an engineer, and we would have gone out and somebody would have given us $5 million. So we got that far. We've raised $1 million. We're getting ready. We hope to close the second tranche of another $1 million, which is all we're going to need to get 510K clearance at the end of the year. So the earlier panel, for those of you entrepreneurs that might have been depressed in the room listening to the venture, there is a new model. We're kind of developing it as we go, but we've got to change the way we think about developing, I think, early-stage medical devices.
So, Jim, let's turn it over to you because financing stability is certainly one aspect of execution. At Welsh Carson, you're kind of middle market private equity, so you don't see the really early stage stuff. I wonder if both of you could talk about the kind of financial, the implications of execution in terms of financial strategy. And Nancy, it's interesting to me to hear you say that you're pioneering a new model because in one of your previous companies, you kind of got caught up short. I mean, at Picardi, you had a great example of deep-pocketed investors who put in a lot of money and were willing to go with you. But LMA, you had a very different experience with your investor base. I wonder if you both would talk a little bit about financial strategy, financing as part of the execution strategy of a company. And maybe you just want to tell the LMA story before as you frame that question.
Yeah, so because it has changed my view of how you finance these. First, let me start by saying that in the world I grew up in the last 30 years, even though I have an MBA, as an entrepreneur, I was never worried about the P and the P&L. I was only worried about driving top-line revenue because companies were usually acquired as a multiple of revenues, not of profit. So it's not a discipline that, for many of us, we know very well. So So that was, I think, a very important lesson for a MedTech entrepreneur. My last company was an aesthetics company. It was a laser-based company called LMA. And we had the fortune or misfortune to raise money in the summer of 2008, right before the market crashed. And we were selling a cosmetic laser. And so we decided to quickly conserve cash. We were able to get our product on the market, commercial in 20 countries, had revenues running just under $9 million, and our venture investors decided they wanted out of the space because of the financial markets. Aesthetic products trade as consumer goods and not as MedTech. I don't know if Bob's still in the room, but he can tell you that many of those public companies had a negative enterprise value, the public companies in the sector. So they decided, for a host of reasons, we had to sell or wanted to be sold in very short order, which I was able to do, sold the company to a public company, Cynosure. They took the warranty obligation, most of the team, but I was a significant investor as well as the VCs, and we didn't make any money. So one of the things I learned there was that the next time I wanted to do a technology that was not a big idea from a PMA point of view, because I sat on 2 PMA boards, so I get enough of that fix. But I wanted a 510K that was somehow going to be involved with the changes in healthcare delivery, which I believe is going to be faster, cheaper, and involve mobile. And I wanted to scale a business that I could get to profitability before anyone else said we had to sell the business. So that's really changed the financing strategy. So that's why I was saying 5 years ago, we would not have self-funded, just in-kind services and things. We're probably over $1 million, and we put all of our, cash into the deal. We don't need much, and we've set it up so we can get to break even with a total of investment of only $6 million. So we could fund it ourselves if we had to.
So, Jim, we're one issue that we're not taking into account here is the time gap that Nancy keeps referring to. Things are different today than they were. But let me turn it back to you and to kind of respond to Nancy's comments. At both at Boston Scientific and now Welsh Carson, you sit on the opposite side of the table. You are assessing companies who come in. To what extent are you seeing that poorly capitalized or financially constrained companies have an impact on the execution? That you're finding companies that come in and haven't been able to do everything they should have, haven't been able to accomplish everything they might have, simply because they haven't either planned their financing correctly or haven't had access to capital. And I guess those are two big differences, where they haven't planned it properly or where they've done their best, but they haven't simply had access to capital. But what is a poor financial kind of grounding or structure mean to the executions issue?
A lot in your question. Let me take a crack at answering it. Then if I don't do it, come back at me. Because clearly, from a Boston Scientific perspective, which I think is reflective of strategics today, if they're going to make the BD investment, they're looking for yellow to green lights on all the key due diligence elements. If there is an important red light, they could not go forward. What's interesting in this constrained exit environment, I still believe for companies that are making it through it, they are getting good exits. The RDNs is, the far right example, but I think if you make the list of M&A that's been done by the larger strategics, they're being done at good, solid valuations. It's not like the valuations have imploded. It's just the number of deals and what's required to get done by strategics and the broader execution dimensions they need to meet have moved up. Within that shift has been created a window for someone like Welsh Carson with more of a growth capital investment perspective. The nice thing about our fund, we have $4 billion in our latest fund. Half of it's dedicated to healthcare, but based on our focus on healthcare, we tend to be healthcare focused, but deal size agnostic. So we will, within the product world, we're with Warburg in a Bausch & Lomb, which obviously was a classic buyout, large company, but we're also investing in some earlier stage companies that need a infusion of growth capital. It may or may not been that they've gotten their funding wrong, but they've hit a stage which, because of their focus on their P&L, that they've been forced to optimize their P&L in such a way that they're underinvesting in their long-term growth prospects. If they're not getting the sort of exit they would like at this point, they value a lot bringing in a growth capital partner to support them to the next phase. The other interesting dynamic that's happened is a lot of the companies we're investing in now have a semi-red light on the table to strategics, and we can provide an added window to those strategics to clean up the company and get them more fully baked before they go to execution. So we invested in a orthopedic spine company, which is a very good company on a number of dimensions. It had tried to explore exits to strategics. Strategics, not surprisingly, in the new compliance world, were fairly concerned that a large portion of their investors were also a large portion of their current customers, the classic physicians base. And so part of the role we're playing beyond helping them grow in a number of dimensions is to clean up the investor customer base, so there will not be an issue when strategics come in next around a dimension that created a lot of heartburn for the strategics last time. And I could walk through each one of our investments, and there tends to be both the dimensions of giving them capital to really more fully execute their plan that has been constrained because of the P&L issue of needing to manage towards a P&L too early in their life cycle, and also a red-yellow diligence issue that we were willing to take on, work with management, and help them clean it up and get after it going forward. So this clearly is an interim strategy because it is dependent on good companies being started, funded, and brought along, and currently there is a window out there because of the VC dislocation. It'll be interesting how this plays out over time.
It seems to me that one of the biggest issues, execution issues, is building the team. Now, Nancy, you said you were very proud of the teams you had both at Procardia and at Target. I'm sure you feel the same way about your current company. But we could spend an entire day talking about how you build the right team. But it seems to me, looking at small companies, there seems to be two philosophies, one of which is run lean and mean and make as little investment in top-tier talent that's going to be very expensive because capital is very expensive. And the other is hire grade A, top A number one people right away. You'll execute a lot better. You'll drive value a lot better. As you think about, Jim, the companies you've seen, and Nancy, the companies you've built, and also some of the other companies that you know from your just moving in startup circles, how do you go about, what's your strategy or philosophy about building out management teams? Should they be robust and hardy from the very beginning, or would you rather run lean and mean and not hire a commercialization person or not hire go outsource for a QA/QC person, regulatory person, reimbursement? I mean, how do you think about those? How do you approach that issue of building the team?
Well, I think it really depends on the technology. My general philosophy is always to get A-plus players, and I've always hired people that are smarter than I am. That's a minimum requirement to be on the team. But I think in the new business models, it doesn't really allow you capital-wise enough money to build out the whole team right away, nor in some cases do you want to, I believe. In our case, a big piece of our business model is reimbursement because we were going out as a software as service. We're changing that dramatically, and we have to fit under all the CMS codes. We could not have hired one person to do that role for us. We have a whole organization, and we needed all of their expertise. So we found the best that we could find. So I like to say we have A-plus consultants. So our reimbursement consultant is that. Our regulatory consultant is a senior cardiovascular regulatory person that's been through the FDA with 3 similar devices. And actually, one of our development partners is a multi-billion-dollar company outside the U.S. that is interested in our technology in their market. So we're working on a collaboration there. So from the software quality side, it's a little bit like dancing with an elephant right now because they're so big and there's 6 of us,
Mobile health is a new space right now in the whole area. Digital health. If you were back in a cardiovascular startup, do you think you'd take the same approach? I mean, one of the things that we didn't talk about in the last panel is the increasing role of corporate VC as a kind of replacement for or surrogate for traditional venture capital. When you talk about going to a multi-billion-dollar company with a development deal, are you doing it out of necessity, out of lack of experience, or why go so early to a major company that could either be a competitor down the road or might perceive to limit your exit down the road?
Right. In our case, the reason that we made that decision is we felt that 2 things. Time was of the essence, and we wanted to make sure that all of our quality met all the new V&V requirements at FDA, or we wouldn't have an exit down the road with anyone, right? And the second part is we don't give them the algorithms. So all of the secret sauce, which is not part of the IP, but the know-how and trade secrets are all done in the U.S., so that's done internally. So we outsourced all of the kind of heavy lifting on the wireframes, the running the challenges, and we needed to know that whoever acquired us would be able to have confidence to really what you were saying, Jim, because if you had 6 people, we're at UMass Lowell in an incubator writing the code for, this kind of thing, you might say, do these people know what they're doing, and is it going to pass scrutiny during an acquisition? So we did it for kind of both reasons. But we do keep back the pieces they would need to ever run it themselves without us.
Jim?
So from a management perspective, I would very much resonate with what Nancy says. From as you get in from a Welsh Carson perspective, we would look most for the core group of key managers. To the degree that they had all A team, wonderful, but to the degree it was not an all A team and there was some A, B team members that were in essence outsourced, that is fine. Part of our growth capital role is to come in and support the team to build the next level team to get them to the next level, which usually is a focus on international sales in certain areas to pick and focus in on. Usually the tricky issue is around the core founder team and exactly what roles you want them to play in the next roles. Usually as we're coming in, there's enough wealth being created that we do look for the core group to roll some of their personal capital that they're gaining back in to have real skin in the game. And then as you think about the next phase of the strategic exit, I think the data speaks for itself. It's basically the company that's been created and the commitment from the management team to make the transition and integration work. Because I think the data tends to say, 2 years after most acquisitions, what portion of the core founder team is left around playing a core role? It is relatively small. So you can say all the nice things you want to say, and both sides always say those things, but the reality is huge wealth gets created. There's a set of DNA within the team that was involved in creating this company out of nothing, and there's a half-life of about 2 years, I guess half-life probably about 1 year, on the reality of these things, and you're fooling yourself if it's anything different than that.
So because I was actually going to raise that issue of what expectations the founders, whether they're physicians or engineers, can expect as you execute, as you get further down the road. And your answer surprised me a little because it seems to me that one of the biggest issues that particularly today founders face is that because of the financing climate, they get diluted down to nothing almost immediately. And the next conversation is, how do we get this guy out of here? Because he's really not, he's a smart engineer or he's a smart physician, but he's not the guy to take this company to the next step. I mean, isn't the more likely scenario that sometimes keeps companies from taking that next step, that the founders get very protective of what looks to be a very tenuous position going forward as new financiers come in, as new executives come in, and as the company kind of stalls in its development path?
In either exit hat, we become most focused on whatever talent is critical for the future success of the company. We don't spend a lot of time focused on the talent that is not critical to the future. So if the founder got diluted down and is not critical to the future, almost shame on the founder for not managing their position over the time. If the founder is still playing a critical role, we'll make sure that they have skin in the game going forward. The broader issue.
But do you see one scenario is taking place more often than another?
Well, the issue we see playing most often is within the boards and the range of equity interests that exist is how much misalignment there is, especially when we're negotiating with Welsh Carson versus strategic, as to what the right decision is going forward. And a lot of it has to do for what's the timing they got in, what venture fund they got in, and all these sort of time return issues. And so you get into these long set of debates with board members with very different time horizons and return expectations. Some get very excited about getting a reasonable return now, rolling it back in, and having the chance to partner with us to get a bigger return long term. Others have to take the money and run and want to continue to wait by the phone for the strategic to call up with a big offer, even though the objective data is, they've been sitting by the phone a while, and that phone isn't suddenly going to magically ring for them.
So, Nancy, you've held on to the CEO position through several of your companies. Tell us a little about, from your perspective, you've had partners, other founders. How do you deal with this notion that as you build out the management team, some of the guys who were critical early on no longer have a role to play going forward? Or do you try to, for corporate cultural reasons and for a lot of other reasons, do you try to make certain that those people who were there at the very beginning, stay at least through some reasonable period of time? Are you relentless that if you're past your time, you're out of here? Or do you make accommodations for folks who were critical, but the company's clearly in its next phase?
So it's an interesting question because I've done it a number of ways depending on the situation. So I don't think I have probably the best example is that I've had a couple of physicians that were founders that were on the boards. And as we raised additional venture, the board members wanted them to move to observer roles, which, frankly, when you're on a venture-backed board, and I've been on about a dozen of them, unless you're doing an acquisition or merger, there's not much you're doing at a board meeting that makes any difference anyway. So, but I've had physicians just go crazy that they didn't have voting rights at the board. So I've spent a lot of time mentoring them and even a couple engineers that just having observer rights is enough to know what's really going on at the company, and you should be really happy with that because you get to do everything except vote, and you have no fiduciary responsibility. So you get like the best of both worlds. And what I found is if you're candid with them and talk to them about practically what happens in the governance of the company, that you can get through that. I have had situations though because my usual tenure at a company is 6 to 8 years, where we have gotten to a point where some of the technical founders lost interest, right? Because we weren't really innovating. Now it was really reducing it to practice, trying to scale it. They wanted to do other things. And if in one case I was able to have someone do some basic research that was relevant and kept him in the organization, in another company we had to say, look, you're not interested, we're not, let's give you an incentive. We accelerated some of the stock and let him go do something else that was of interest. So I think your goal as a CEO is that you have to do what's best for all the stakeholders. But I have to admit, I try to be accommodating, nice, and mentor people to understand that most of the time when the investors are coming in and they give you a seat at the table, you should be very happy because not everyone will do that. So
we're right up against time. Are there any questions in the audience? Here's one over here.
I think there are a couple of questions there, so let me try to break them down. In our case, we could have been a class 1 or class 2, but class 2 is more typical and it's more conservative. And I live outside of Boston, so what can I say, right? It's in my DNA. I'm very conservative. So we decided to go for class 2. We also thought it would be more valuable for a strategic to have the class 2 clearance.
And which company are you talking about here?
I'm talking about InfoBionic.
And you already have strategics identified?
We've already mapped out the 12 companies that we think could be potential acquirers, and we've looked at all of their acquisitions for the last 5 years. And our space is kind of hot right now, mobile health. So we also have like payers and some of the storage companies and software companies besides the usual suspects of cardiovascular companies. So we've been trying to look at all of those. And my partners come from those spaces, so they know those companies too. But no, we really made a decision on what would be the best practice to build a business with what resources we had, because we don't have the growth capital yet, so that we could get the most value during an acquisition. And we 99.9% believed we're going to be an acquisition, not an IPO. And also, we knew that in our case, our technology was not Class 3 PMA. We're disrupting a market that's been around for 50 years. Ours is more of a business model play than a pure technology. We're using technology, but it's more business model play. So did that answer your question? On the
Let me ask, if I can, just as we wrap up here, ask his final question a different way. Howard Levin this morning said that one of the first lessons he learned from an old mentor is that it takes the same amount of effort to do a big idea as a small idea, so you might as well do a big idea. But it seems to me that from an execution point of view, and a lot of people made a lot of money in medical devices and incremental advancements, from an execution point of view, a small idea is a lot easier to do than a big idea. So much stuff goes wrong along the way, stuff happens, things go wrong, and the bigger the idea, the more disruptive the idea, the greater the potential. From an execution perspective alone, would you rather be doing a smaller idea with a more obvious path and plan going forward, or to your mind, does it always make sense to go for that big disruptive home run?
Goldilocks. I think
Isn't Goldilocks like the middle?
Goldilocks,
like the middle range.
Be in the middle.
Yeah.
Which is the history of doing incremental Me Too ideas that counted on a healthcare system with incremental innovation to pay more. I think that window is disappearing, and we need to remember that a lot of the medical tech industry has been funded on the model of invest in R&D to bring out that new hip with some limited benefit to manage our price realization up, which is exactly the opposite of the fundamental technology industry, which if you think about what the tech industry is all about, is really log changes in price value over time. The MedTech needs to shift to that. At the other extreme, picking the big home run idea that if you think about all the variables that have to go just right and the amount of money, time, energy, and effort to do it, those are going to be few and far between in which they line up. I think an Ardian passed that test with so many companies because it seems to be a procedure that you really can't imagine can work, be doable, et cetera, despite it being an insightful idea and insight into the path and how it works. I think the in-between world is worth factoring all the trade-offs, because unfortunately, if you think about all the risk factors you're dealing with, you stack up my 4 questions with each of them having 3 or 4 sub-questions, you're into 16 hurdles you in essence have to get a yellow or green light, no red light on it. And like any process, that even if all 16 of those, and someone can do the math faster than I, if I told you all 16 of those were 99% probability of getting right, you still multiply 99.99, you have a low probability of success. If any of those variables, and those are usually true with the big home run ideas, instead of being 90 to 100%, are actually 50-50 toss-ups, your probability of going through that long effort process comes way down. And so I tend to believe that it's important to think about all those factors, the trade-offs, and be honest with yourself which sort of opportunities you develop. And I heard Art sort of indicate that for himself. As the cardiovascular world, when he adds them all up, it has caused him to believe the grass may be a little bit greener elsewhere, which he'll either get proven right or wrong on that debate. But clearly the diagnostic world is a little bit more the Goldilocks just right space today for some investors and some of the more challenging PMA type paths.
Nancy, I'm going to give you the last word. We have one question over here, but given the choice, maybe you think mobile health is the home run destination, but from an execution point of view, is it a misnomer to think that the incremental is easier and less risky?
Well, first I want to challenge the question of what's the big idea, because I think to what Jim said, we grew, all of us, or most of us, some of you are much younger in the room, grew up believing that new technology or new procedures were the big ideas, right? And that was what we were focused on. But I happen to believe, as Jim said, in the tech model, where the big ideas now are what we're doing in mobile health, which is where healthcare delivery is changing. We can deliver things faster, cheaper, and without disrupting the workflow for the doctors and get reimbursed. I think it's a huge idea, but it's not a big technical risk, right? Like Ardian did, where they imagined that we could, or Procardia did, where we were trying to put a stent into the coronary sinus and bypass through the ventricle. I mean, those were big physiologic procedure, technology challenges. I think the challenge for us as a country, if we're going to get healthcare cost containment and continue to innovate, is to find these incremental improvements that improve the quality of care, because we're all driven by making it better for the patients, but at the same time not try to take on these big mountains of technology. And I happen to believe that digital health or mobile health is that category.
We'll just take one question over there.
It is more managing your cash burn to critical milestones that matter than the P&L per se early on. The revenue matters in the sense that it's demonstrating the dog will eat the dog food in some market, and we all know you can do clinical studies in a controlled environment and then put the product in actual physicians or the medical community hands, and you can get two types of results. So at least at Boston Scientific, we learned it was very important to get someplace where the product was actually being used before you really had the confidence in the potential. But I would not take that to the extreme that it's all about the revenue you can driving, because there really is such things as focusing too much of your energy on commercialization, put too much of your investment to maximize revenue, and having that at expense of doing some other things that are more critical to get right in that same period of time. So to me, it's cash flow to critical milestones and thinking what those critical milestones are. And if a revenue happens to be demonstrating the potential of the technology in real hands, then it's important.
Great. Well, we're going to break there. On behalf of first of all, let's thank our speakers right now. I think I neglected